was seeing there was a wholesaler that came to town. I'd been going to meetups for a while in LA, and LA has had, at the time had a lot of meetups about real estate. And so I saw it was like, oh, you can get a 10% return. The guy was selling like turnkey properties or something, and in all over the country, different markets of the country. And it showed like, Phoenix was like 10 to 12%. A lot of these markets were 10, 12, maybe 14%. And then it showed Cleveland was like, I was like 17 to 20%, cash on cash. And I was like, well, what the heck? That was an outlier. I was like, why does that exist? And so I thought, well, let me look into this. And I didn't want to necessarily buy a turnkey. I thought maybe I can buy houses and fix them up and just start to develop it.
Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we are joined with Bronson. He is the managing member of Bronson Equity, GP in 2,500 plus units worth $250 million, host of the Mailbox Money Show, author of Fire Yourself, and leader of the Wealth Forum for Elite Passive Investors. Bronson, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Thanks, Josh. Excited to be here. So I was a well-paid medical sales professional. So I was making over $200,000 a year. I was working, going into surgical procedures with physicians, and there was a lot of things that were great about it. The thing I didn't have, I didn't have control over my time. And a lot of people say they want financial freedom. For me, it was really time freedom. I wanted to have time to be able to travel and time to be able to create. And so I made a goal for myself. I said, I want to quit my job in 3 years. I didn't quite know how I was going to do it, but I found a way through getting involved in real estate, doing bigger deals. I'd been doing some single family and realized if I scaled up and did larger multifamily deals, raised money from other people, I could find a way to do it much faster. So it was just under 3 years I left, was able to replace my working income with passive income. And it's been, we've had some amazing home runs. We've had some real challenges at times, but it's all been, it's been great. It's definitely been a growth process for sure.
So you mentioned you got into single family first, correct?
Yeah, correct. Yeah.
Tell us about your first deal, how you found it, how you got into it, the leap forward, and then the progression from there.
So I guess it's a little bit, maybe this is a common story or not, but I kind of became an accidental landlord where I had in my mid-20s, I bought a house. I was living in Montana. I moved out there for a job, and ended up, when I left Montana, I ended up just keeping the house as a rental. And so I had it, and I just subconsciously realized, man, this thing's producing, 100, 200, 300, $400 a month. Over time, it scaled up, and I was like, this is not a bad idea. And so I thought, well, let me get some more of these. So I started doing more single families, actually, in Ohio. And I was buying in a part of Cleveland that was not a great part of Cleveland. So on paper, the numbers looked phenomenal. And after, the tenants not paying and the city being a pain in the butt and all the different things that happens with old houses, it just wasn't scaling as quickly as I wanted. And that's what made me think. But I mean, we were buying some of these houses in Cleveland. This is after I did, the first one in Montana. It was, $15,000 to $30,000. Like the first one we bought, I think it was probably $30,000. We put $15K into it, and it rented for, $1,000 a month. It was pretty amazing.
Got it. Interesting. And then how did you discover multifamily? Was it just a progression, or because it's taking a leap?
Yeah, it was taking a leap. So I had my plan was to get 30 houses, 30 rental houses in Cleveland, and be able to replace my income, or at least make six figures basically. And then I realized it was just going to take a long time. It's gonna be a lot of work, and I ran out of capital. And then I have, there's that saying, when the student is ready, the teacher appears. So I have a cousin who I hadn't seen in a while, who said, hey, why don't you do multifamily? I said, well, like apartments? I was like, I don't have the money for that. And he said, well, you can raise the money. And so he taught me about syndication. He said, you can go to this conference, listen to this podcast, read this book. So I just did everything he said. And then within a short period of time, I'd started a meetup in Southern California. We had 60 people at the first meeting. Met my first investor there, connected him with another guy at that meeting. It was raising capital. So I basically just kind of connected two people, money with, the capital with the project. And then over the next 6 months, I tried to find opportunities, just wouldn't find the right opportunity. Then I found a partner who was doing a lot of big things in multifamily. And I said, hey, what if we work together and I help you scale up? And it became a really, great way to be able to grow.
You said you were buying properties in Cleveland, but then your meetup was California?
So I live in California. I was doing out of state single family, correct? Yes, I was buying out of state. So I had a whole team. I had a contractor, and there was kind of a method I was taught to, you buy where the numbers make sense, live where you want, but buy where the numbers make sense. And the numbers at the time looked really good in Cleveland.
Man, that's because that's a jump across the pond. In Cleveland, it does have there are good pockets. Of course, Cleveland's huge. There's definitely street by street, just like any city has. what made you choose Cleveland out of all the cities?
Well, at the time, I mean, I was seeing there was a wholesaler that came to town. I'd been going to meetups for a while in LA, and LA has had, at the time had a lot of meetups about real estate. And so I saw it was like, oh, you can get a 10% return. I was selling like turnkey properties or something, and in all over the country, different markets of the country. And it showed like, Phoenix was like 10 to 12%. A lot of these markets were 10, 12, maybe 14%. And then it showed Cleveland was like, I was like 17 to 20%, cash on cash. And I was like, well, what the heck? That was an outlier. I was like, why does that exist? And so I thought, well, let me look into this. And I didn't want to necessarily buy a turnkey. I thought maybe I can buy houses and fix them up and just start to develop it. So I had a mentor who was helpful in just kind of building a team. And the nice thing, like even with multifamily, a lot of the multifamily we've done, it's none of it's been in California, right? I've lived in California the whole time. So it's, the nice thing is, when you're nearby, you can swoop over and kind of fix things up and kind of be more involved. But when you're not, you have to really learn to trust your team. And you make trips, you get on a plane, you do whatever. But a lot of times when you're not there, you have to plan for, how can I make sure this thing is going to work when I'm not here? So then it becomes that you're actually creating a business that is more scalable than you having to be there. So from the CEO or the scalability perspective, that's actually, I think, a better model in general, no matter what you're doing, because if you have to do the work, then you're limited that, you've got to be there and kind of be the one doing everything. But a lot of times I've realized we don't have to be the ones actually doing much of anything. As long as you have people on your team that can do it. You obviously got to check, and you got to make sure that you're, getting the quality you need and the metrics that you want. But there are ways to get there with building a team.
Yeah, no, I totally agree. And investing out of state, it's almost like once you get your team hooked up, once you get everything plugged in and it works, then you can go. It just goes from there, versus being in your backyard where you're more prone to be more involved. And I say more involved, literally in the weeds, day to day involved, versus
Yeah.
going out scouting new deals, underwriting, and being a more of a service for your investors. Um, what are the fundamentals that you like to see in an operator when you're looking to deploy investor capital?
Yeah, so we work with a lot of different assets now. We were only doing multifamily initially. We raised $15 million. Just found a partner to work with. It just made a lot of sense. So I, basically became equity partners. Then I realized, well, a few years ago, things started shifting quite a bit to where there's a lot of things that make sense, that actually cash flow, right? It's really hard with real estate to find cash flow, which is really what allows people to quit their job. We're talking about in my book, Fire Yourself, behind me here. That's how people actually can do that. So we look at oil and gas. We've done oil and gas projects. We've done debt funds in the real estate space. We've done some VC type of stuff as well. But I think great operators communicate well. A lot of times we get a lot of introductions. I'm sure, like yourself, there's people that always, trying to pitch you something. Especially if you're a capital raiser, you get deals all the time. And we say no to almost everything, just because a lot of times we just no, has somebody actually invested with this person before, with this group before? What's the experience of that person been? So one group that we love working with, how I get introduced is the same cousin who introduced me to multifamily has invested with this group for the last 8 to 10 years, and they've had a great experience. And I've invested personally, and so we've had multiple. So I'm like, well, what else can we do with these guys? Because I know they're people of integrity. I know their character. A lot of people want to raise money from investors, and then they never want to hear from investors again, and they feel like they're kind of a nuisance. And I just think from a perspective and approach, it's like investors should be partners. They should be able to reach out when things go well or things don't go well. I mean, it should be like, you're in this together, so that there's a lot of great communication. So the only way to really figure that out, I think, is to either find somebody you really know well that has invested over a long period of time. And actually, there was a new deal that came up recently, and I was like, it sounds like an awesome deal. Involves marinas, which is like, like boat marinas. There's like 10,000 marinas that look at lakes, in the U.S. But great operator. It seems like a good operator in the space, but I don't know them. I know somebody's invested with them recently, so I've got to give it some more time. But it's like, it does sound like a compelling investment opportunity. But still, I can't move forward until I've got enough track record or people under, like that I know that have actually done that. And if they give me referrals, it's not the same as me finding referrals of people that have worked with them. If that makes
Yeah.
sense.
I think one of the biggest misses, and it's cheap and it's free and it's easy, is just basic common sense communication. Just
Yeah.
send out at least a monthly update, best biweekly. Just keep them informed. Here's what's going on in our property, whether it's stabilized or not. Just communication is it's so easy, and a lot of people have that miss. Even just communication to the bank. Bank's a partner too on a property
Yeah.
or investment, no matter what. And they like to see the updates as well. So it's just those little things that really just make people feel involved and that the property is still there. Things are going like they should, and
Yeah.
but it's one of the biggest misses. And I agree with you. The operator, the track record is the most important thing because deploying the capital is easy in a sense because the deal is always not always. I mean, if you underwrite right, it always looks better than what it is. But if the operator's truly done full cycle deals and the underwriting seems legit, then it's easy. It's an easy deal because the operator's been there and done it. What has been
Yeah.
your experience with, I'm going to say, subpar operators?
Yeah, well, it's interesting. To be honest, the last few years have been really tough for a lot of people. The challenge, just be honest, we've had a few deals we did that we got in with, bridge debt and, end of 2021 or something. And the value of a property in Atlanta went down by 40% over the next 24 months. Right. And if you're 20% down on shorter term debt, you're in trouble, right? Because now you're negative equity, right? It's just really, and this is something people don't talk about as much right now. They just want to talk about all the wins. But and also, a friend of mine, Ken McElroy, he's got 3 billion in real estate. He did the forward to my book. I mean, they've had deals where they've lost money on. So I don't think it's ever that somebody would never have something bad that happens. It's just how honest are they about what's actually happened? How are they talking through? And this is a great question I ask or just operators in general. Tell me about a time where something didn't go well, and if they don't have something to share, it's like either they're not being honest or they just don't have any experience, right? And so it's I think people these days, when everything is going to AI, even now with the AI videos and all the things that are out there, there's so much fake everything out there.
Yeah.
That now there's influencers that are fake. There's videos that are fake. I could literally put videos of me talking and the whole thing is fake, but you wouldn't really know. And so I think when people are just showing up and they're being authentic and real, and this is what has actually happened. So I think the big thing with great operators is communication, learning lessons. We learned a lot from what we went through. So we said, okay, we only want to do longer term debt type of deals. We did a deal recently with a large storage operator that's $1 billion operator. They've got a great track record. And, it's a 6-year fixed 5.75% interest only debt. There's, it's 51% equity. So this is an over $100 million deal. They raised over $50 million for this deal. Right. So things like that, where you just get, if you've been in something, you've ever been in something challenging, sometimes the benefit that you get from taking on a lot more risk, you get a little bit more benefit, but you're taking on way more risk, right? So we've kind of looked at, I've really tried to, every deal I try to really evaluate and say, on a scale of 1 to 10, 1 being a treasury or money in a bank account, which those still have risk, it's just less risk. And then a 10 being a early stage VC deal, like where does this fall on the scale, right? And I try to actually assign a number to it. And so there are things that I assign a 2, out of 10. Some that we assign like a 5 or a 6 or a 4. I just want to make sure that I understand kind of where we're coming from on this. And so I think, great operators will, really have looked at different things that could go wrong. They'll have an answer for things. They'll say, hey, here's what we did in this way. And a lot of times it just comes through experience, and it comes through experience of both good things as well as bad things. And again, I know guys that, I know a guy that sold all of his multifamily stuff a few years ago and did really well and whatever, but I also kind of wonder with this guy, does he not share the bad things? He's like, everything appears to be really good. And he's got a long, great track record, which is great, but it's still like, there's something there that's just like, oh, is he still just trying to present what sounds good versus like Ken, who's amazing. Like hey, we had this, we lost money, whatever. Those kind of share, just be very open, and you feel like you're getting the real person.
Well, and it is truly, it is so much less risk when you're dealing with somebody who has had those scars, the bad deals, the things that have went wrong, because they won't do it again. If they've learned their
Yeah,
lesson, they won't go back and do it again. And
exactly.
that's what builds wisdom, is through experience, versus somebody who's just a gun runner, run and get out there and get it done. And it's just things don't go as planned. What's the backup plan? What's the team look like? What's the good, the bad, the ugly? I think a lot of people got blindsided when the rates started going up with their bridge debt. They bought over leverage. They bought at a performer price, and a lot of good people, a lot of good investors are paying the price of just negligence, really, on the forefront.
Yeah.
Um, what have you seen out there as far as anything come to fruition on deals gone bad?
I mean, it varies. There are some deals that get repackaged and kind of put into some sort of recapitalization that if you get, a certain metrics, like if the new owner, came in and bought and took over the loan, if they get a 25% return per year, then you get a certain amount above that. So the challenge is it's kind of open-ended for investors. It's hard to say what's going to happen. Other one, and you hear stories too. A lot of people that were doing this a few years ago are not doing it anymore. A lot of people have shut down and kind of done other things. And it's been challenging for investors too, because the cash flow, that's one thing that real estate, in most real estate deals, it's hard to find cash flow. In single family, there are areas where they're cash flow positive, meaning you can pay the mortgage and you're getting some cash flow each month, but it's not as common as it was a few years ago. It's harder to find that, especially in places like California. You get a negative cash flow. You could be paying $10K a month for a payment on a $1.2 million place, and it rents for $4,000 a month, and that's the market rate. So you're paying $6,000 a month for the privilege of being an owner there. Right? So I think you just have to look at the numbers and really figure out. Kind of a lot of investors I speak with is, what's your goal? Is your goal, if your goal is leaving your job or firing yourself, or if it's retirement, well, maybe cash flow is important. So maybe it's time to look at other things. I think it is a good time for multifamily real estate, but not from a cash flow perspective, right? So there's other deals that do that really can create that for people. But there's always opportunities every market. You just got to be willing to look and be patient and find the right opportunity.
Yeah. You had mentioned AI. What are you seeing on the horizon with AI in general?
Boy, AI, man, that's the hot topic. I was at a Tony Robbins event recently. I do a lot of personal development work, and he said that he thinks that over the next 5 years, between AI and robotics, human life, the way we live, is going to change more over the next 5 years than they have over the previous human history put together, like many thousands of years. And I think it's probably true. I mean, we're getting to the point where humanoid robots will come in and start cleaning our houses and taking care of old people, and drivers. I think there's 8 million drivers in the US that just drive either trucks or Uber or other things like that. Could all be automated. And I think we're going to start to see some of this. And it's going to happen very quickly. And I think people have to, there's going to be a pushback against it. But I think being willing to be nimble and flexible. And of course, when you own assets such as real estate, or you own a business, or you own oil and gas, or you precious metals, or you own other things, those things will retain value. You can't AI those things away, right? There's no technology in sight that is on the horizon that somebody doesn't need a roof over their head or a bed to sleep in, right? So I think if you're a real estate owner, you're going to do just fine no matter what kind of happens there. But I think if you're an accountant or something, it could be, hey, we found a way to automate that, and all of a sudden you've been doing it for 20 years and you've suddenly out of work. And I think you've got to be thinking, okay, what is next? What are some things that I can learn? What are some things I could do that could be related to this? Where I mean, it's funny how the STEM, it used to be the science, technology, math, all that stuff was like super important, and they're like now it's like all that stuff's done better by AI. And so now it's like the things that are soft skills, right? Like sales, or maybe things you can do with your hands if you're a mechanic, or if you're a plumber or something. Like, some of those things are really, really valuable, because it's going to be quite a while before a robot can come in your house and fix your plumbing. Eventually that will happen, but it's not probably quite a bit down the road. So, but there's a lot of this we just don't know. And that's where, again, owning assets, having things that do cash flow, put money in your pocket, is going to give you a great place to be more secure going forward, for sure.
Yeah, I think there's a ton of unknowns, and it's hard to. You don't want to be a fear monger, but if what is already happening keeps on escalating, because companies are they're at a race against each other. The corporations are at a race against each other, because ultimately it's what companies are embracing AI the fastest to produce valuations, returns, by cutting
Yeah.
cost. And I don't think there's not a good ending to that, because a lot of these jobs are those middle management roles. Yeah, you kind of have to go vertical and see what other companies are hiring for the same role that haven't adapted yet. But ultimately, it's just something that I think keeps progressing. And then at the end, you think, what happens to my industry? So single family houses, the valuations, if nobody can buy, because ultimately the underwriting's not there, then
Hmm.
your price for real estate, I mean, it can only go down because you don't have a buyer there. You don't have anyone on the other end that can produce the payment. So I guess it's taking a step back and seeing what that looks like on the big perspective of where the job markets are heading, and then your tenant base, dropping your whole entire rent roll into some couple of LLMs, and seeing what your exposure looks like on that front as well, and then just seeing what the exposure is. What does this look like on the spectrum? I think a lot of things are going to go to vouchers, no matter what. I think vouchers are going to explode in a sense, but just being kind of prepared on the what if this happens, then then that, if this then that scenario.
What do you mean vouchers? Like, what do you mean by that?
Section 8 subsidy. I mean, there's a
Oh,
lot of,
yeah,
they're not necessarily LIHTC. LIHTCs are great
yeah,
communities, but just in general, subsidy for housing.
yeah.
I think that humanoids should be reserved for the military only. I think putting those out into just general population for them to take over ultimately what humans do is going to be a massive disruption. And I think they're
Yeah.
here and they're learning the human strokes, how the cleaning works, how cooking works, and
Mhm.
they're teaching data right now. So there's things that are here that are on the forefront that are just happening so fast, and I think
Yeah.
it seems slow, but when it's here, it's going to happen overnight.
Yeah, and I think most people are starting to get a feel for it now. There's a lot of fear around it, but I think up till about 6 months ago, a lot of people, I don't really know whatever. But I mean, you're seeing it now. You're just starting to see things. I mean, even in LA, it's like self-driving cars are all over. Like you see these self-driving taxis. There's certain regions that there's all over. You see 5 in a row. There's people picking. They're like with the Waymo cars, and then you'll see little robot delivery things that are delivering food like on the street, just like going down a sidewalk, right? It's just like it's just kind of all over. And so eventually, where it's going, we don't know. We hope that, if you hear the philosophers like Peter Diamandis or Elon talk about it, it's like, yeah, there's a risk here that AI becomes really powerful and whatnot, and we have a Terminator situation. Hopefully, it's not that, but I think it's just going to be something over time. We're going to have to continue to find meaning in what we do. I think there's, the thought 30 or 40, 50 years ago was that we would just be working by option. Today we just be working optionally. Well, now we work more than ever. So I don't think it's going to lead to less work. I think it's just going to lead to work is going to be changing.
Hmm.
Now I think there's this Amazon plant in Alabama that it employs more robots than it does humans, and they sort everything. But the people that work there are maintaining and watching and fixing the robots, right? So if you're willing to fix robots, there's a huge market for you, right? So I think that just the ability to be flexible and realize that capitalism is great, but has a creative destruction, and you've got to be willing to learn new skills.
Yeah, and that's the big piece: learning new skills, learning how it works, how to be a part of it too. I think there's
Mhm.
such a learning curve when it comes to technology of who can adapt, who can utilize even just creating an agent. How the there's plenty of videos of how to do it, but connecting everything. So
Yeah,
um, there's a lot of things on the forefront, and it's kind of like what segment are you in? What are you investing in? Where are you going to be at? What does 5 years look like from now? And just trying to position yourself to be on the right end, because there are going to be winners and losers. Unfortunately, that's just the way it goes. But
yeah.
um, what kind of tools are you using for underwriting or for just portfolio analysis?
So we use a lot. I mean, honestly, I feel like they say AI, the LLMs or the Chat GPT programs or Grok or whatever, they're the worst today than they will ever be, right? They keep
Yeah,
getting better and better. And it's, we've had them now for a couple of years. But like I love just taking a PPM and putting it in Chat GPT and saying, hey, evaluate this based on my goals, or what are the biggest risks here, or rate this on a scale of 1 to 10, or what are the things, and it just gives you all these great questions to ask. Now, it doesn't, take into account the nature of the relationship you have with the person, or there's things it's going to miss. But I mean, things that used to take, I know somebody literally got paid, hundreds of dollars an hour to read PPMs and to go through line by line, whatever, take them, 5 or 10 hours to do diligence. You can literally throw this into, Chat GPT and get all the pros, cons. You can ask it questions and just reference things. And we don't think, so I think that just in life, it's coming to a point where it's like, well, what else can I use AI for? Because it's not just like AI is going to take your job. It's the employee using AI or the business using AI. So our employees, like we're continually asking. We were trying to figure out a way on one of our CRMs or our contact management list of how do we segment it this way so that people that have opened our emails in the last 30 days, they keep getting more emails, and people that haven't been opening them don't. And we found a way to kind of go through and create automate, just very simple in Chat GPT. But I think that this exists in business, but it also exists in life. How do I manage my life in this way? How do I improve my health? I'm a fitness guy. I don't know if you're into fitness, but I do these competitive races. I'm one called High Rocks coming up in 2
yeah,
weeks.
yeah.
Like a
CrossFit. Yeah.
Yeah, it's like a CrossFit kind of race where you run 5 miles. But it's like, okay, I need to do that. What's my recovery meal? What do I do here when I train this? Should I cold plunge? Should I do sauna? And it's like, it's just all this information that we didn't have. And it's like having a coach in your pocket for anything. And so I think that those people that use it are able to make their lives better. And in some ways, it almost can be, you can become too dependent on it. but it's a great kind of consultant. They said, so what would you do if you had somebody who had a 1 in 10,000 IQ or 155 IQ just like sitting right next to you? And that's what ChatGPT is like. Well, what are the things in your life you need help with? And just start talking and having conversations around it. So I think there's a lot that people that actually think through the results of their life and what they want and what they're actually getting and how do you change that. There's a lot of great ideas that can come from it.
Yeah, and gain clarity. Just have it ask you the questions, gain clarity, so you know exactly where you're wanting to head and what it looks like.
Yeah.
I totally agree. There's a lot of tools, a lot of ways to kind of get different edges on different things, but at the same time, other groups are doing the same thing. So if you're a
Yeah.
little bit ahead, it just gives you a little bit more edge, and
Yeah.
you
True.
might find that asset underpriced and be able to capitalize on it. So.
Yeah.
Um, Real quick, you'd mentioned oil and gas. One of my buddies, he invests in oil and gas, and he seems to like it pretty well. What have you seen from that industry?
Oil and gas is really interesting. I never thought I'd be an oil and gas investor. It's funny how you never say never, just kind of be open. But one of the big issues most people have is there's three main issues. One is cash flow, as I mentioned earlier, because that's what allows you to cover. A lot of money someday is great, but how's it actually going to help me to pay my bills and take vacations and make work optional and that kind of thing? And the second thing really is tax benefits, right? So people that are paying, more than, you know, 20, $30,000 a year. And there's a lot of people paying, I know a guy's paying $500,000 per year in taxes or people paying millions in taxes. And there are ways, the tax, this has been with oil and gas for over 100 years. And it came out to incentivize oil and gas. So there's almost a 1-for-1 of what you invest. It can reduce your taxable income. Right. So I'm not a CPA, but this is like, if you search this in ChatGPT, this is in the tax code that $100,000 invested in an oil and gas drilling deal reduces your taxable income by about 85% typically. So that means if I make 200,000 a year, I put 100,000 in a deal like this, it shows my income at the end of the year is 115,000. So on that additional 85,000, what would my tax rate have been? Would I pay 20%? Well, that will save you, 15, 20 grand just right off the front on that deal. And so that's what I think is really awesome. And typically they cash flow very quickly and they cash flow pretty strong. It's usually, depending on the operator, a payback of principal, we're looking at somewhere between 1.5 and 3 years, which is great. And there's cash flow kind of beyond that. And oil and gas drilling, it used to be, it has this reputation of being very risky. And I think there are risks there. But when it comes to dry holes, it used to be about a 30% dry hole rate back like 30 years ago. Well, now with technology, they'll put in electrodes in the ground, they'll have geologists come in, they'll use AI for modeling. They'll know with like a very high degree certainty that there's oil down there. And what they'll do is actually drill kind of next to the well. They'll go down a mile down and they'll go like 2 miles across and they'll hit it. And it's like, it's not 100%, but some of the partners we work with, they've had a less than 1% of dry holes. So we'll do packages of larger deals where it's not just one well, it's usually 10 or 20 wells or 5 wells or whatever it is. And so if you do get a dry hole, it's not the end of the world. So I think that a lot of people just aren't really aware of it. There are some fly by night people in there, so that's where reputation and who you're working with is very important, and making sure people disclose their fees and things like that. But I think that any asset can feel a little scary when you're new to it. But in my book, Fire Yourself, I kind of talk about how do you analyze a deal of any asset class and have it really make sense for you. So I love the tax benefits, I love the cash flow, and those are two things that most people really need.
Yeah, and everything comes with risk. That's what makes the investor the investor. So it's
Right.
very cool, Bronson. If a listener wants to reach out, learn more about yourself, learn more about your company, how can they get a hold of you?
Well, I have a gift for your audience, Josh. There's a guide I put together. It's called How to Use Inflation to Your Advantage. So, how do you actually use inflation rather than it hurting you? They say it's only 3% officially. I think it's more like 6, 7, 8%. If you look at costs, everything's twice as much as it was 5 years ago during COVID. So, inflation probably is higher than what they report. So, if you text the word inflation to the number 33777, it gives some ideas, real estate, debt, precious metals, some things you probably haven't heard. And that's a great way to connect and also hear about kind of what we're working on in the future.
Very cool. Awesome. I definitely appreciate your time today. Look forward to following you. Thank you.
Thanks, Josh. Appreciate it.
All right. Bye.